Good morning, it's Jeffrey Cohen. How are you? It's Friday, February 16. Wow, is it a crazy day in the market? So we're going to talk a little bit. Market opens in 27 minutes. And we made a lot of progress yesterday on setting up what I call our managed accounts or our hedge fund. And we call it a hedge fund because it's actually hedged 100%. And so I'm going to show you. I'm going to show you the kinds of stocks it's picking. It's pretty interesting. I've got to just clean this up a little bit for you. You know what? I'll move these to the top. I'll show you. It's so interesting when you really think about kind of how you're going to manage money and the emotions of it. There's a lot. There's a lot going on right here. So the first thing to note today is that it's options expiration date. And so what does that mean? That means that individual stocks have options to buy or to sell. And you can see that what we're looking at right now in the market is equities are significantly lower. And actually we looked because we have to look at pre-market prices to set up our weightings on our portfolio that we're managing. And again, we're paper trading it now in order to get the kinks out, to work out legitimate processes and procedures that are repeatable. And before we would ever take on investor money, and then actually before we're going to put our own money in it. But so let's see. So very red today. Now the VIX is up. So people are betting on a crash and they're selling stocks, which is fine. If you take a look, the 30-year bond is down 0.6 to 130.81. This effectively means that interest rates are going up. Long-term interest rates are going up, and they're really in this, it's not a secular decline. It's a consistent long-term bear market on long duration, long maturity U.S. Treasuries. These are risk-free, right? If we look at the 10-year, I don't think it's quite as straight down, but it sure looks quite as straight down. So you've also got the 10-year Treasury. If we look at the 5-year, you see it's another one of these it's a more gradual decline, but it's down. So guys, bonds are down. My guess is if I were to look at mortgage-backed securities, that mortgage-backed securities would also be down over let's look at 3 months, right? It's gradual though, right? It reached a high of like 101, 102. It's down to 98. Now, this is the uniform mortgage-backed securities with 4.5% average interest rate. Let's look at the Ginnie Maes. These actually dropped through the floor, and I think part of it is you're not going to be getting a lot of principal repayments now. Let's look at the 5%. It's a little less of a drop to the floor than the 4.5%. If we look at the uniform MBSs, pretty big drop, a little less drop. The reason why these are dropping, not that I'm some expert on mortgage-backed securities, because honestly, I'm not. I'm looking at mortgage-backed securities for a different reason, because of a different reason. But here's what's important. The 30-year fixed rate on a 30-year conforming loan is up to 6.33%. So let's say I have a mortgage that I set up in the last 5 years, 3 years. The odds are my interest rate is less than 6.33%. So new mortgages are going to be great, right? New mortgage, the bank is still going to make its 3.5% markup. They're going to double the interest rate when they make it a mortgage, right? And you're going to hate it, but you're going to buy it because you moved. It was for a job. You wanted a new house, whatever. But if you're refinancing, there's very, very little chance that your mortgage is greater than a 6.33% on a conforming 30-year fix. Now, if you're a junk bond person, an Alt-A mortgage, God help you. But for regular old mortgages, they're down. So I just want this to kind of sink in, because It's a big backdrop to what we're facing now. So if I go back to so what else is important? So we talked about the futures. We talked about equities. Let's talk about oil and gas. So crude oil is down to under 85 bucks a barrel. Not a huge deal, but it's fallen a little bit. Gasoline down to 241. Silver stayed strong, but look at gold at 1669. I haven't seen gold at 1669 in a while. And so I mean it was down recently that low, but just in general, gold's supposed to be a hedge. I don't know what it's doing. Gold is dropping it's got to be interest rates. Interest rates go up, gold doesn't pay any interest. So this is one of those where if you're looking for the contrarian bet, you look at Newmont Mining, which is the best gold miner. And you can see pre-market it's down. If we look at over a year, look at that thing. 80 bucks down to 40 bucks. So Newmont at half price. God, Hillary looks terrible. Look at that face. She's fat. Go to the gym, Hillary. You look terrible. I digress. Let's go back. So the other thing to look at, the market's been interesting. It's kind of bouncing up and down each day. You know what? I'm just going to dig right in. So we run our model every night. We ran it. By the way, we've changed a lot in order to make it easier to manage and run money. So let's start and show you what we found yesterday. Oh, it's big. First thing I want to show you is that the variance of the S&P 500, this would be a chart you'd make that shows all the sizes of the ups and downs of the S&P 500 and how the current S&P 500 would have a lot of movement and the old S&P 500 moved less, right? And so you see this reduction of liquidity, an increase in volatility of the S&P. Well, it's been this gradual increase, which is fine. If you look at the volatility or variance of all the profitable stocks, it's 2.2 times 10 to the negative 4. That's actually, it's high. It's high. And so you can see the different stocks it picked, right? Apple and McDonald's and Berkshire Hathaway. Oh my God, who's going to be doing that? And BlackRock and Yum Brands and Honeywell. So here's the thing though. You could run these numbers in about 10 minutes. No problem. But this isn't the portfolio. What's interesting is that our job runs super duper and it gives you this portfolio, which is 70 ticks better than buying all the profitable stocks and just sitting back. It's not a huge hedge. I mean, not a huge edge. But this is what you got, 22 stocks. Now on the downside, I want to show you that. So by the way, I have those stocks, so I don't need to copy them for you here. On the down run, you can see the volatility of down stocks is 6.1 times 10 to the negative 4. It is dramatically higher. There's only 457 down stocks that pass our data validation because we really tightened it up because we're going to be trading these now, at least paper trading them. These are your worst stocks. So based on a client's recommendation, and we miss you, by the way, if you're watching, we'd love to have you back. I know you'd appreciate we get this managed fund set up because it's like free money, right? So VERU is not a pharmaceutical company. So we don't want to trade pharma because pharma has this asymmetric risk return profile that all of a sudden some molecule works great and cures cancer and the stock goes up 100 times. Or the FDA comes out and says, we don't like this drug and the stock drops 80%. So it's too hard. But Veru, that's a consistent name. Desktop Metal, AMC, Snap, Peloton, IonQ. These are stocks that the model has been saying have way more risk than the expected return. And so we pick a few of those, we put them in our model. We're not actually recommending that we hedge the model with those, because yesterday it actually lost money if you hedged with downrun. But I just have a feeling that this is going to end up being something special. And so we're running a paper test on hedging with downrun. Short the downrun, long the uprun, I should be getting twice as much return. Market's a little crazy now, so it's not quite working that way. So Jeffrey, what are you doing? And by the way, why are you sharing with us your picks? What are you, some kind of a, weirdo? Why would you share the picks with us? Well, because we're still paper trading it. We're still learning. So, and what I wanted to show you is what we learned and what we're doing, because I have a feeling you're going to benefit from this. And we don't have a whole lot of time. So the model recommended 2 sells and 6 buys. That's a lot of action, probably too much for us. So we only held like 20, let's say there were 25 positions with longs and shorts. So I don't want 8 transactions. That's a lot of transactions. Transaction costs kill profit in a model. So what can we do? Well, the model wanted us to sell SYNA and LNC, but we haven't seen an SYNA sell recommendation yet. So we're going to hang on to it. And the last time we sold it, back in the day, we had to buy it back. So LNC, though, it's also an in and out, but we'll sell it. It's also, when we scroll down, it wasn't in the top portfolios. But we still see SYNA after only 5 ticks of loss of edge. So we'll keep it. So we're going to sell LNC, Lincoln National Corporation. Now, the model wants us to buy a lot of names that you know and a few that maybe you don't know. Tesla, Meta, Macquarie, Lam Research. Claire, I don't know. Claris Corporation, I don't really know. And Ares Management, it's fine. It's a small money manager. So we've decided we are going to buy, wait a minute. Nope. It's funny, I have my notes for the video. I got to update them. Here we go. So we're going to buy Tesla, Meta, Macquarie, and Lam Research. But we are not going to buy Claire and Ares. They're both first-time recommendations. And we'll wait till they show up again. We're going to hold some capital back. So then it's interesting. So now we're selling LNC. We're shorting 5 shares of the Spider. And this is just for our weighted beta. This is what we have to do. So that's about $2,000. And then we're going to short more Veru, more Desktop Metal, and more AMC because the price has dropped. So we have to short more in order to offset. And then we're going to buy 3 Tesla, 6 Meta, 100 Mac, and 2 Lam Research. And on a cash basis, we're about even. So we're starting to track our fund based on a $50,000 notional investment. You hold stocks. You short stocks. I want to make sure we have cash to buy back the shorts. And then a little bit left over because we might need to buy more or things may move. And compromises we made in the model is we're going to hold SYNA, Synaptics, just because it's the first time selling a while and I don't want to be buying and selling it. And we won't buy these 2. Everything else is automatic based on market prices. And so that's what we're going to do this morning. That's so interesting because that doesn't feel very emotional. That doesn't feel emotional at all. Now, let me tell you about emotion. I go for runs every day because I'm down $41,000 on a $51,000 left portfolio. So I'm dying here, right? Emotionally speaking, I made some bets that went the wrong way. So if we look, and here's the pre-market, we got Corbis. You know I love Corbis. We've been talking about it for years. This is a stock where, given enough time, some of their drugs may work. And then the stock goes up a lot. Cullen Frost Bankers. We are short Cullen Frost Bankers, and we are the owner of some puts. It's interesting, Jeff. That's a Texas state bank. I believe that they actually gave up their federal charter and they're just a state bank. Like $9.5 billion in market cap. It's a very interesting stock. Do you know that it trades at about 2.7 times book value? Not tangible book value, all book value. It's a pretty penny. Verizon continues to fall, and you can see I have a lot of calls. I have September, October, November, and January calls. We are very bullish on Verizon as an oligopoly play. Only 3 providers in cell phones. But also they're offering corporate networking, which used to be the purview of like an AT&T, but in fact they're offering, of course, you have your fixed lines, you have your fiber, and now they have direct connect wireless, fixed wireless they call it, and all that, right? And so it's so interesting. Verizon is going to do okay. And they signaled yesterday or 2 days ago with the Goldman Sachs meeting. And I finally understand the CEO is not a knucklehead. The CEO may be the smartest guy in the room. Here, I posted this tweet. I think it's important for you to see it. I don't know if you follow us on Twitter. By the way, all of this is free. Unless you want to buy a run and really dig into the numbers, which I'd be happy to do it. If you buy a run, I'll explain everything. I love doing that. It's actually the most fun I have is talking to clients. And in my opinion, the CEO of Verizon was actually speaking to the CEOs of T-Mobile and AT&T when he poo-pooed discounts on services and on promotions on Apple phones at the Goldman Sachs conference. I was wondering why he tanked the stock $1 billion. I was so upset. I have all these calls, and he killed the stock. And I'm like, why'd you do that? Why'd you sound like such an asshole? He said things like, oh, I don't want customers that are, price sensitive. And I don't want, I don't want to give money away. Just what I realize is, a rising tide lifts all boats, and he doesn't want to race to the bottom. Now, T-Mobile has always been racing to the bottom, but all T-Mobile has to do is, raise their prices $5 a month. Far be it from me to complain, because then AT&T can raise their prices $5 a month. The next thing you know, Verizon raises their prices $5 a month, and then T-Mobile raises their prices. And by the way, Apple could just lower the price of their new phone. It doesn't have to be $1,500 for a new phone. Right? I bought this beautiful Motorola phone. I've had it for 5 years. Probably paid like $500 for it. That's all a phone should cost. And guess what? $500, 5 years, $100 a year, $8 a month. Verizon could have financed it for me if I wanted, right? That's not bad. So I want you to think about this. Maybe they could pressure Apple to reduce the price of their phone when sold through a telecom. Love it, love it. Verizon guy, pretty smart. Last but not least, I've been tracking Verizon debt on Trace, which I get through FINRA and Morningstar. And I think they bought a lot of debt back yesterday. I'm watching them buy back debt at 75 to 85 cents on the dollar. Every time interest rates go up, their debt gets cheaper. They have the money. They're generating like $34 billion a year in free cash flow. They're buying debt back at 20 cents discount. Doesn't mean I'm right. And it doesn't mean I'm right now. Because I am getting my ass handed to me on these calls. But it does mean long term, I'm also long the stock. And if I can get any money out of those options, I'll probably just buy more stock. Because if they can stop this race to the bottom, everybody wins. All right, I want to thank you for watching. If you liked the video, if you found it helpful, by the way, futures are still in the toilet. Look at that. S&P 500 is down 1.25% on a Friday. The VIX is going up, right? Interest rates going up. This is a terrible day in the market, right? You should never be going long. Our model is about even. We're buying 5, but we're shorting some other stuff. So if you like this, hit the subscribe button on YouTube. It helps us. If you want to learn more about our business, because maybe you do, check out the website, www.chicagoquantum.com. I love it. It's what I do. We're registered investment advisors in Illinois. If you're an Illinois resident, we can serve an unlimited number of you. It's awesome. If you're from another state, then I can do 5, right? And then I got to go and get some other paperwork done with the state investment departments. But that's fine. So right now, give us a shout. We'll talk to you. You can check out our brochure on the website. Down on the bottom here, brochure. And if you want to buy a run, we'd love to do it for you, and then we'd love to talk to you about it. And I think you'd learn a ton about the market and how we think about risk and return, and we'd help you out. So have a great day. Good luck. Love you people. Bye-bye now.